Did you know? The wealthy are 3 to 5 times more likely to profit in the stock market. It's not about luck. It's not about insider information. The truth is, wealthy investors possess 3 distinct advantages that most ordinary investors lack. Today, we're pulling back the curtain to reveal what gives the wealthy this incredible edge, while so many others remain stuck in a cycle of losses. Let's start with a fundamental question. If you had $10,000 versus $10 million to invest, would your mindset be the same? A study from a securities firm in Shenzhen revealed a stark contrast. Clients with over 5 million Chinese yuan in their accounts held stocks for an average of 18 months. Small retail investors with under 50,000 Chinese yuan held for just 28 days. This isn't about innate patience. It's about the psychological safety net that significant capital provides. Real-life example. In March 2020, during the pandemic-driven market crash, a business owner watched his 20 million Chinese yuan portfolio drop to 12 million. His reaction? He calmly transferred another 5 million Chinese yuan to buy the dip. His thriving main business generated 8 million Chinese yuan annually, so his stock investments represented only 20% of his total assets. The short-term paper loss didn't impact his lifestyle. Contrast this with Xiao Wu from Hangzhou, who invested 150,000 Chinese yuan, money earmarked for his wedding. When his stocks fell 10%, the stress was unbearable. He sold as soon as he broke even, only to watch the stock triple afterward. This illustrates the first major advantage, the financial safety net. The wealthy invest with true idle capital, money they can afford to lose. Many ordinary investors risk survival capital. A 5% loss triggers a panic response. When you're investing money you cannot afford to lose, you're not investing, you're gambling with your livelihood. The second advantage, information processing power. Wealthy investors don't just have more money. They are better at building a comprehensive investment map from diverse information sources. A 2022 study by Shanghai Jiao Tong University's Finance School found 73% of investors with portfolios over 5 million Chinese yuan regularly read industry research reports. 41% had professional networks within their invested industries. Among small investors, less than 50,000 Chinese yuan, only 12% read research reports. A staggering 85% relied primarily on stock forums and social media for tips. Case study: Li Jie learned from her husband, a semiconductor engineer, about a chip material company that had broken a foreign monopoly. The stock was at 15 Chinese yuan. Instead of buying immediately, she studied the financials. R&D spending had grown 30% annually for 3 years. Noticed institutional investors were quietly accumulating shares. After her thorough analysis, she invested 300,000 Chinese yuan systematically. She sold when the stock reached 68 Chinese yuan. Her colleague, Xiao Zhang, bought 50,000 Chinese yuan based on a forum post claiming the stock would double. He panicked during a minor pullback, sold at a loss, then FOMO bought back in at a higher price later, ultimately losing 20%. This isn't just an information gap. It's an information processing gap. The wealthy connect disjointed information into a coherent logical chain, analyzing industry trends, company fundamentals, and money flows. Ordinary investors often fixate on stock codes and price movements, jumping on any hot tip without verification. The third and most critical advantage, the toolbox versus the casino mindset. Wealthy investors treat the market as a toolbox for asset growth. Ordinary investors often treat it as a casino for getting rich quick. Case study: Auntie Wang, a retired teacher, received a 3 million Chinese yuan Chaichan demolition/relocation payout. Her boring but robust strategy: 1 million Chinese yuan in bank stocks for dividends, 500,000 Chinese yuan in leading consumer stocks, long-term hold, 800,000 Chinese yuan in index funds, 200,000 Chinese yuan for speculative theme stocks. Her goal was a steady 5 to 8% annual return, outperforming wealth management products. Over 5 years, she achieved a 9.2% annualized return. Her neighbor, Xiao Zhou, found slow wealth building unappealing. He poured all his capital into hot sectors like new energy and AI, cycling through 27 different stocks in 5 years. His portfolio ended down 15%. This highlights the fundamental difference in mindset. The wealthy use an allocation mindset. The stock market is one component of a broader wealth-building strategy. The ordinary operate with a gambling mindset. They see stocks as a lottery ticket for rapid social mobility. The 3 common pitfalls of a scarcity mindset in investing. Pitfall number 1. Making breaking even your primary goal. After a stock drops, the first thought isn't, is this company still valuable? But, I'll sell as soon as I get back to my cost basis. This is known as the disposition effect, the tendency to sell winners too early and hold losers too long. The harder you focus on just breaking even, the more actual investment opportunities you will miss. Pitfall number 2. Mistaking hype for opportunity. During the 2023 AI frenzy, retail investors accounted for 85% of the trading volume in the top 20 AI stocks. When the hype faded, 80% of these retail traders lost over 20%. Chasing hot themes isn't seizing opportunity. It's providing exit liquidity for smart money. Wealthy investors ask, can this trend last 3 years? Is there real profit backing this story? If the answer is no, they stay away. Pitfall number 3. Confusing short-term volatility with real risk. Many see a 5% dip and panic about risk. The true risk isn't price fluctuation. It's investing in the wrong company that never recovers. Your 3-step action plan to change your trajectory. 1. Insulate your investment capital. Use the 100 minus your age rule. If you're 30, invest up to 70% of your idle capital. If you're 50, invest no more than 50%. Idle capital equals money you won't need for at least 3 years. Money you could lose entirely without impacting your standard of living. Open your brokerage account now. If the money inside isn't truly idle, withdraw a portion. This is your first step toward eliminating investment anxiety. 2. Install an information filter. The next time you see a message like, "This stock will double," ask, who is saying this? What is their evidence? Does this contradict what I already know? If someone recommends a stock, open the company's annual report. Check for revenue growth and improving gross margins. This is 100x more reliable than blindly following the crowd. 3. Lengthen your time horizon. Data from the Shenzhen Stock Exchange shows accounts holding stocks for over 1 year had a 55% win rate. Accounts holding for under 1 month had only a 23% win rate. From today, before buying any stock, ask yourself, if I were locked in and couldn't sell this stock for 1 year, would I still buy it? Only click the buy button if your answer is a confident yes. The final truth. The wealthy don't excel at investing because they are rich. They become rich because they invest wisely. Their secret weapon isn't the size of their bank account, but their mental framework. They view the market as a tool, not a casino. They adopt a long-term perspective over short-term anxiety. They employ rational analysis instead of emotional herd following. Remember, investing isn't a race to see who gets rich fastest. It's a test of who can survive and compound the longest. Start today. Replace the thought, "I need to get rich quick," with, "I am committed to getting rich slowly." Once you make that mental shift, you are already halfway there.